Welcome back to another episode of On the House. I'm really excited today to have a guest. I've got Greg Iverson with Neighborhood Loans joining us. Welcome, Greg.
Lindsay, thank you very much for having me. Super excited today.
Yeah, so Spartan Invest and Neighborhood Loans have worked together for I'm not sure how many years now. You financed hundreds of properties for us. So tell us a little bit about yourself and your company.
You know, they say people like most to talk about themselves, so I could probably do that for an hour, but I don't want to bore the audience. It really doesn't matter, but I'll give you the relevant stuff as to why, we're active in this space, what got me here. So, '08, I was super young back then. I still some days feel young, some days I don't, but
the days are smaller now, right? The days that you feel young, they're dwindling. Sorry.
They are. This morning was not one of those days I felt young, no. So, so anyway, that was obviously we know what happened at that time, and went out and got a real estate license right away and started buying foreclosures. Again, for anybody that's studied this stuff or even done a quick Google search, 2008 was for a real estate investor in this space, single family rentals. Those were some of the best days that we could have ever asked for. So I started buying a bunch of foreclosures. I utilized what's now known as the BRRRR method. At that point in time, I did not know that that's what it was. I just knew that it worked, and good and bad, I have an addictive personality. The first one worked, got through it, and I'm like, this is awesome. Just at that point, incredibly naive to a lot of things, but I knew that worked. And so, started just buying as many as I could get my hands on. At the same time, I quickly realized that, this likely at that stage, the cash flow on these rental properties, I was in for the long haul. They probably weren't going to pay my bills until I started to accumulate several, and so always kept the day job, which I advise most of our clients. And that's what I love about the turnkey space. I think when you keep your day job, you accelerate that game plan so much faster. So I kept the day job, which is, doing mortgage lending. But at that time, Lindsay, it was just primary home buyers, second home buyers here and there. Which is great, but I'm not gonna lie, that's not as much of my passion. Seeing somebody buy their dream home, I think it's awesome, but it doesn't get me excited like the investment world does. Fortunately, in 2016, I started teaching continuing education to realtors here in the St. Louis market, and then started to kind of branch out from there, just on real estate investment. And that opened a whole new world to me that I did not know existed. In the first 10 years of my career, whatever that was, I had no idea that turnkey even existed, honestly. And when I kind of married the two up together, I fell in love with it, And so this is 2016. I've got all the rentals, and then all of a sudden, our mortgage business just takes off with the mainly turnkey and investment. And fast forward here now, 2024 as we're shooting this, I would say 80% in this market of the loan production that we do is just to investors. It's so cool that you always hear, and it's kind of cliche, but do what you love and you'll never work a day in your life. Let's be real, work is work. But when I'm doing that and I'm speaking the language and I'm talking to folks like you and your team at Spartan, your clients, it more feels like I'm talking about my hobbies in a lot of ways, and so it's not, if I get up in the morning and read about real estate for an hour, that's not work to me. It's something I enjoy, but then It adds a lot of value to, ideally to Spartan, our other clients, but it keeps me sharp, in my own investment life and that sort of thing. So that's what got me here. As far as where it's going, going forward, we've really structured and built our loan production team here on investment lending. It's again, just to go back to 2016, I remember, and I'm sure you remember these days, it was not every lender wanted to do turnkey investment. A lot of them turned their noses up at it, specifically in a refi market. I don't want to mess with these small loans. They're more complicated process. Yep. They're buying 3 properties, all that kind of stuff. We, unfortunately, my team more than me, embraced it and loved that. And I'm like, well, let's just go all at it, And now it's a little bit more of a crowded space, but it's still, we find that our clients, they look to people like you, they look to people like me that have done this for a long period of time for kind of that sounding board, obviously for advice, but as a resource when interest rates shot up, it helps to talk to somebody like Lindsay that can say, you know what? I bought my first 10 and my interest rate was 8.25%. I didn't know any different. It worked just great, and I
Right.
think bringing that experience, I almost feel old saying it, but I think bringing that experience to the table helps those that, even if they are somewhat seasoned, but particularly those ones that they're just now getting into it. It's like, yeah, I need to line up with somebody who's kind of been in these types of situations before, and they've seen
Right.
the positives, not enough to say, well, I'm out of it. I'm out of the game type thing. So that's us. And I couldn't be happier. The fact that I'm sitting here talking about investment, it's, again, I feel like I'm living a dream a lot of days. Hopefully it stays that way. We'll see.
I completely agree. It's honestly one of the very big joys. Now, we had an investor come and join us and tour our facility yesterday, and the employee that gets to, our customer service manager that gets to take him around, she's like, he was so knowledgeable, because so many of our investors, their passion is real estate. She was like, I think I learned more from him than he actually did from me. I don't know that I was very helpful. He was just so informative. And so I completely agree. Being able to be in this space day in and day out, it doesn't necessarily feel like a job.
Totally.
But yeah, I want to go back to what you said as far as like 80% of your loans are in the investor space. Well, kind of from on the Spartan Invest side, it's like 73 to 75% of our investors are using leverage funds. Like they are financing their properties to purchase more properties instead of doing an all cash purchase. And
Yes.
there's several benefits. There's several benefits to buying all cash. It increases your monthly cash flow, but if you're financing the property, that just increases your rate of return because you're not out of pocket that much capital, and then your tenant then pays down your mortgage. So when you're looking at the differences, it is good to have a partner in the lending space like Neighborhood Loans, like Greg and his team, to be able to rely on that experience. And I want you to touch base just on, let's say I'm a new investor. What are
Mhm.
some of the things that I should be doing, not doing when I'm getting ready to finance my first couple of properties on the conventional side?
Yeah, absolutely. And you hit the nail on the head. I always like to say, as a disclaimer, I do lending for a living. So I am obviously very pro leverage. But Lindsay, the honest truth is, in my own life, if I have the opportunity to leverage something small or big, the returns, it's just not even close, And the flip side of that is being careful that it's not, that leverage is not choking your cash flow out. You've got to be mindful of having that cash flow, but your ability to scale and grow is night and day better when you take on that leverage. Not to mention, it's one of my favorite calculations to run, and I won't go all the way into this calculation unless we have time at the end. I might touch on it, but is when I make my down payment, say it's 20%. What is my actual return on using just 20% of my own cash, and in the investment? So I'm locking up, say, $100,000 property. That $100,000 property is performing like a $100,000 property. So if it's appreciating at 3, 4, 5%, it's not based on my $20,000 down payment, and your returns literally skyrocket versus a cash purchase of 100,000. Plus, obviously, the fact that you can scale considerably quicker, which is a lot of the name of the game. As long as you're careful with it. As far as do's and don'ts, in general, and this is preparing for financing, preparing for buying rental property in general. Major do's: one, keep an eye on your credit report. There's a free service through the government where you can order a credit report on yourself every year. It's not a hard inquiry, so it does not show up, does not have an impact to your credit scores, but really keeps you in tune with what do my scores look like. That is such a big part of the terms, maybe the largest part of the terms that you negotiate for a loan, wherever you go for a loan. Neighborhood Loans, bank down the street, anything like that, it's so crucial what that credit score looks like, and so slowing down. And if you're, next year is my year to start scaling up again. I bought a bunch of rentals. I sold a bunch. I still have several. Next year is my big year. So I'm spending my time this year thinking about these exact same things, making sure my credit's where it should be. And oftentimes it's something snuck up on you that you don't even know about, medical type bills, those
Yeah.
notoriously complicated to keep up with, so first and foremost, protecting those credit scores, and making sure that those are as high as you can keep them before you buy, when you buy, after you buy, again, so you can continue going forward with it. So that first and foremost. The other thing I think that makes sense is in the case of a spouse, partnership, whatever that might look like for you, your family, really mapping out a plan from day one of like, where are we going with this thing? Is 5 properties getting us where we're headed? If so, great. Are we more like probably Lindsay and Greg that say, nah, it's like 100. And then when you hit 100, it's like, no, I think it's 200, and that's cool. Whatever it is for you. I think getting clear on that before you ever even apply for a mortgage, before honestly, and it can happen while you're doing that, but just getting clear, because that's going to have an impact on how you structure things, your bank accounts, you use LLCs, all that sort of stuff, so really getting clear on that. Talking to a lender before you even apply, one of our favorite things to do, and we do it on nearly every client that will allow us, is before you even actually, go to the online loan application or do a loan application, let's talk for 30 minutes, have a conversation with Lindsay, have a conversation with us. Hey, here's what I'm thinking of doing. What are my best options out there? Do I utilize Fannie Mae, Freddie Mac? Do I do DSCR? Explain to me the difference in paying cash. Sometimes we'll see where a borrower will pay cash and then they'll do a refinance right away and take that cash back out. So addressing those types of things are again crucial to making it a smoother. There's only so much you can control in a real estate transaction, as we know. There's other parties involved. There's financial markets. There's all this stuff. The stuff that you can control, I look at it this way: like, I have to absolutely own that stuff and be thinking about it constantly, the stuff that I exercise control over, because it's going to make my overall, my portfolio perform better, but just my overall process in buying them, it's not going to make it to where I say, this is the greatest headache ever. Why would I ever do this? But hey, borrowing money and giving a whole bunch of financial documents and stuff like that, I look at it as, well, that's kind of like, that's like an honor. I feel we have it. Let's be real. Like, I think a mortgage lender is probably second to going to the dentist. Like, people are not super excited to go get a mortgage. I look at it as like, yeah, but it's the harder it is to underwrite me, that means I'm doing something right. Oftentimes we find that the most successful, real estate investors or in a career, self-employed individual, whatever it is, those are the toughest ones to underwrite. And so I always have to remind myself, like, this is like a compliment. If you're asking me for a 70-page tax return or whatever, if it's smaller than that, it means I'm probably not making as much money, or I'm not at least getting the at-bats, and so those types of things. Understanding your tax returns, that's another big one. We have a lot of clients we will talk to that, their business is performing incredibly well. When it gets to the adjusted gross income, for a number of different reasons, which are for the most part legal and understandable, that might come back to bite some folks in terms of qualifying, and so it's a matter of figuring out that balance in the way that tax return is filed to, again, be mindful of tax implications, but also, what do I qualify for? I've heard them called golden tickets. There's a lot of different ways to describe a Fannie Mae, Freddie Mac type of loan. But those are typically the gold standard. That's what we want our borrowers to qualify for first. And those are the types of things we need to talk through, before someone actually goes to apply, as opposed to, which DSCR loans are fabulous. They serve a great purpose. It's just oftentimes those, especially in this market, can be more expensive. So if there's other ways to qualify, we want to do that. So, those are big ones. Employment, just being mindful of your job stability. If I've had a number of clients we've talked to that have said, hey, I'm miserable. I can't wait to get out of this place, but I'm going to stay here until I buy my 10 properties or until I buy the next one or whatever, And so again, understanding that when you go from like a W-2 employee and you're chasing your dreams, you're a W-2 property manager, for instance, and you say, you know what, I want to be the next Spartan investor. I'm going to do this. I'm going to go out and become self-employed. keep in mind that could slow down that progression of you being able to
I'm
buy.
so happy you're talking about that because that is one of the biggest slowdowns we've seen, just the self-employed versus the W-2. Oh, and by the way, you're throwing yourself in there with the dentists. Man, that's pretty rough. That's, Greg, I got to come to your defense on that one.
Well, thank you for saying that. I've had so many people tell me that. I figure, okay, I'll just own it. It is what it is.
But anyway, sorry, continue on the W-2 and self-employment because that's a very big difference in just the financing process.
Well, it totally is, and Lindsay, and that's why I say, like, talk to your team, talk to our team, because we know, and your team knows enough about lending to say, talk to Greg and his crew before you actually do that, because it's almost counterintuitive at times. Like, I remember doing a loan for my brother, and he's in the financial advisory space, and he was named partner, which is awesome, like a huge boost for his career. What happened though? He became a K1, and he was buying his house literally. It was just too late, like right after he got that promotion, goes under contract, and then calls me, and I said, man, I hate to say this, but we got problems, but logically, my brother is way smarter than I am, so my point in saying this is a lot of times it seems counterintuitive, but even something like that from a lender standpoint, all of a sudden that income is not as documentable as that W-2 was, and
Right.
So again, have those conversations and understand that stuff, because a lot of it you would never think, hey, this is a great business I'm about to take on, or I just bought into. We'll go back to dentist. I've just bought into this practice. All of a sudden, I'm self-employed. I can remember one in particular offhand that I look at it. I'm like, they are 100% qualified in my eyes all day long, but they're not qualified,
Right.
and this is why. And so, just being mindful of those types of things. Making all payments on time, again, back to the credit piece, just, organizing your affairs in the right, in the right way. One more thing I'll throw into that, which, this is a little bit, off topic, but something I've been working on recently, and I think it's important, is, talking about having your affairs in order before you buy that first property. Have your affairs in order. None of us plan to just walk out of here and get hit by a bus. The reality is sometimes that happens, unfortunately, and I think about it, and it's like, if I'm building this thing, say, Lindsay, we're building these businesses for our children, for instance, or their children, or whatever it is, we don't want to create this huge burden to people in the process of it, so understanding how is it owned, having those conversations of what happens if, a tenant's dog bites the neighbor. I remember I got one of those calls when I first started. I was literally scared to death. I had never thought about it. And, so just making sure insurance, your other insurance is buttoned up, because as you take this on, again, it is, it's a beautiful thing to build wealth. The reality is, I don't want to say you have a target on your back, but you have a lot more to lose at that point,
Absolutely.
and so you've got to be protected and be aware of that, before you ever even start. So that's aside from lending, but something I firmly believe, it's have it all. I didn't do it the right way, Lindsay, the first time, and it took a lot of years, like really when I met my wife, and she's like, you are a total disaster. This is cool, but man, it's a mess, and so having that stuff like from day one, how's your bookkeeping going to go, all those sorts of things, so those are a lot of do's. I could go on and on and on about them, but do you want to kind of talk about maybe some of the don'ts?
Talk about it, and I know that you've got just a couple of not necessarily don'ts, and I agree. You want to create a healthy fear, and that we're not trying to scare anyone away from real estate. It's obviously a great way to build wealth, but do make sure that we're trying to put as much information out there to prepare you as possible. So talk just a very briefly about a couple of don'ts, and then I want to dive into just the industry today and where we're sitting on May 2nd, 2024, where the lending space looks like right now.
Absolutely. Yes. So real quick, no, my intention and your intention, it's not to scare people away from real estate. If anything, I would prefer to scare them away from the fact that nobody else is looking out for us, and I mean that in the nicest way, but when you're working a W-2 job, you have to kind of take your future in your own hands, and that's what I love about real estate is, and back to the W-2 versus the K-1 and self-employed, my argument has always been, and it won't change, but I also won't ever change any guidelines or anything, that I am way more secure as a commission person, as a self-employed person, because somebody can't come in and just fire me if something happens. I've always felt that is the way, that is greater control, gives me a lot more peace. But the W-2 is what gets the loan. So anyway, don'ts. Applying for new credit. And this is one, I'll just tell you a quick story. Believe it or not, I'm actually refinancing my own house right now. So I practice what I preach. And I have a 2% interest rate, like many people do. I am refinancing. I understand that interest rates are higher now. I'm very well aware of that. I do this every single day. And I am refinancing my home. Why would I possibly do that? Because like many others across the country today, appreciation has absolutely soared. And there is a lot of equity locked up in a lot of properties right now, my primary home being one of them. And I recognize the ability to put that money to work. Now, the reason I tell you that is literally as I'm doing that, I always say, don't apply for new credit while you're doing that loan. I applied for new credit the other day because what do you know? The house right behind the office goes up for sale. I got to buy the thing. So even I forget to do that kind of stuff. And I do this stuff every day. So I say, don't apply for new credit, or if you are, just give us a heads up. I don't want to tell you what to do. And if it helps you move the needle in your own, financial planning for the future, you got to do it. But give us a heads up, because the last thing we want to do is something minor like that you do. And I'm talking to a borrower here, that you do become a nightmare for you, because ultimately the burden comes back on the borrower. We just want to make it smooth for them, So if you are applying for new credit, whatever it is, new mortgage, furniture, any of that kind of stuff, just give us a heads up, so we can document it appropriately. Don't change jobs, or if you do, again, give us a heads up. If you can prolong it, it's going to be easier, but really being mindful of, I'm always afraid to say don't, because I hate to tell people what to do, but try not to go from a W-2 to a self-employed. If that's the dream, you got to do it, but let's get this wrapped up, first. Mm-hmm. Transferring money around is another one, Lindsay. And I think real estate investors, myself being one, we're all a little bit guilty of that, because you're doing a lot of things, and there's money coming from here, there's rents, there's all this stuff. To the extent that you possibly can, try to limit those transfers while you're getting ready to apply for a mortgage, but also while you're in process for that, transferring money, particularly between business accounts, spouses, stuff like that. What happens, and what we always want to try to avoid, is anywhere that something could be considered a gift to someone. I'll give you an example. If my wife has a separate account and she transfers money, I'm doing something and I need some of her money, she transfers it into my account, and I'm buying a rental property, that's likely, unless she is on that mortgage, which is not typically the game in this space, that's treated as a gift. So what did I do? I created some headaches for the loan process, because then, nope, we've got to back that money out. That cannot be used, And so again, if you are making those transfers, give us a heads up, because we may say, if you don't have to do it, let's wait a month. Let's wait a couple months, whatever that is, And then I guess I'll give you two more, because again, there's quite a few. Don't make any large deposits to the extent that you can, and again, what that really comes back to is it needs to be seasoned. It doesn't need to be seasoned. It needs to be documented. And again, that could be a gift from every year grandpa gives you, a gift, whatever that might be. That again could monkey with the process. So before you're about to do that, to the extent that you can, give us a heads up, and then that way we could potentially navigate it. We may say, hey, can you just wait a little bit? Not a huge deal, but it's one less thing you have to answer to, And then the only other thing I'll add to that, and this one came up real recently, as I'm selling one of my properties to a tenant of ours. First thing she said, you know what? I screwed up and I just co-signed on a loan for my son. I shouldn't have done it. I said, yeah, I want to tell you shouldn't have done it. You're helping your son out,
Yeah.
But that could be, potentially become an issue. Fortunately, it has not in this case, but co-signing on loans, whether it's for an auto, a home for, your child, your parents, whatever that might be, Again, I don't want to tell you not to do those things if that helps out family or whatever,
Mm-hmm.
but try to give us a heads up first, because
For
we may say,
sure.
hey, can they wait and buy the car? So
I can see in the real estate investor space, especially if you have multiple properties, you're buying your portfolio, you're building it up, you're having different LLCs with different properties, and you've just got different bank accounts for those entities and moving money back and forth. I can definitely see how that could slow down the process or the approval process. Just with the multiple transfers and not being able to source all of them. So yeah, that's something really informative to watch out for. So
it's
talk a
huge.
little bit about today, and I love what you said as far as you're refinancing your house, knowing that the interest rates are higher, but knowing what that money is just sitting there doing, because there are so many investors out there that are not utilizing their capital or taking advantage of the particular promos or options in the market right now. So talk a little bit about industry today, and then specifically what Spartan Invest is doing with neighborhood loans in regards to the forward commitment. And
Absolutely.
just, yeah, disclaimer too. I know that if you were tired of hearing about the forward commitment, because we've done several episodes on it,
Yeah.
just a heads up. But if you want to learn more about it, we did a full episode on the forward commitment and offering a few episodes back. We'll put that episode in the show notes. But yeah, talk a little bit about that.
It is a fabulous tool. So first and foremost, I'd prefer to talk about 2020, but if you want to talk about today, let's do it. I'm just kidding. Again, I understand what's going on. So, interest rates, this is May 2nd, 2024, the national average 30-year fixed rate for a primary home, which is what's tracked. If you go and Google mortgage rates, that's what's going to come up first. So that's not actually an investment rate, but what it does is it gives you an idea of where things are going, where they've been. As it stands today, the national average is about 7.4%, maybe slightly over that. Probably 3 months ago, and Lindsay, we were just talking about this, that number was probably 6.75%. So we've not yet seen, that interest rate kind of reversal to start coming down like we expected. A lot of us, and when I say us, that's lenders, that's economists, that's experts, believe that by the first quarter and even the last quarter of 2023, we would start to see that come down. We did, but then ultimately they just kind of reversed course and went right back up. So that's where we're at today. In terms of investment loans, which kind of leads me into the forward commitment here in just a second, but likely that equates to a high sevens, potentially even a low eights in certain situations for an investment loan. And these are 30-year fixed rates we're talking about. Now, why on earth would I ever, and I don't get any special deals, believe it or not, I get the same rates as other people do. Why on earth would I refinance my own house and take a rate today that literally it could be almost four times the interest rate that I currently have? Well, again, it's because I'm in a situation that many of us across the country are, where appreciation has gone well beyond what any of us saw coming, at least myself. I didn't see this happening. And I look at idle equity, idle cash as just like a waste, honestly. When you see what inflation is, when you look around at how expensive things are, your money sitting in a checking account or, sitting in my home's going to appreciate at whatever rate it would appreciate, regardless if I owe 0 or 2 million. It doesn't really matter, and what I look at is, wow, if I can extract that much equity, even at 4 times the interest rate, there is a lot that I can do with that, in terms of buying rentals and stuff like that. It's, Lindsay, I don't need to tell you this, but it's a time game, and if I waited and said, well, I got all this equity, but I'm going to wait until rates go to 6% or whatever it is, I'm missing out at this stage, really at any stage. Those years are incredibly valuable. Like I'm sure you have plenty of similar stories, but if I look at what's happened even in just the last 5 years, in my own real estate investment, that 5 years has been crucial. That first 10 years was crucial.
Yep.
If I lose a year, 2 years, 3 years, that's a lot of time that it's hard to get back, and so I think it's important to, understand that it's not it's not always just that interest rate. And I think, oftentimes we're laser focused and we're trained to pay attention to certain things that, yes, an interest rate is important. It's the cost to borrow. However, if that's all we're paying attention to, I might miss the opportunity to take that equity and buy properties when potentially others, because interest rates are higher, maybe others are saying this isn't the time for me, so maybe that creates some opportunities, to be able to do that.
Right.
So that's kind of where we're at. I would say still around election time this year, I believe we'll see interest rates fall. I think it's just a matter of time. I thought it would happen by now, but I believe the next 6 to 24 months, we will see 1% to 2% decline over where we're at today. So that's the good news. That is coming. I also believe probably those properties that I could buy today where rates are where they are, I'm going to have to pay a heck of a lot more for them in 2 years. And I would rather do that and then go back and refinance them potentially if I need to. The forward commitments,
Absolutely.
Lindsay, I can literally remember our first conversation because I was at a conference and I was sitting out by a pool and it was October. And in St. Louis, you're not usually sitting out by a pool in October. I was in Arizona and that was really when I started to engage these, which is a pretty large chunk of the business that we're doing today, are put on forward commitments. I remember hearing about this 10 years ago when I had a lender that had a rate that wasn't even close to anything I could touch. I just wonder, where in the heck is this happening? I tabled it, didn't think about it again until it became relatively necessary, and what it is. And this is why I love, working with Spartan Invest, obviously, but really the real estate community as a whole. It's in times like these, it's us putting our heads together and saying, okay, how can we work together to make this, regardless of interest rates go to 8.5%, 9%, 10%, how can we work together to still make this where it works for an investor, knowing again that it's time and we want it to work today so that we and the, ultimately the investor can capture that time over the next several years, and so again, I know you've done other podcasts, so I won't go into all the details of it, but it's essentially the Spartan Invest, and us coming together and saying, let's work together to, I don't know, subsidize is the right word, but it kind of is, where you as a company that believes in your product, that believes in the clients that you serve, you're stepping in and writing a check to help, make that transaction work for the client, and again, knowing that helps us ride through a little bit higher interest rate environment. And ultimately, that is that's a big needle mover, to be able to borrow today, again, May 2nd, 2024, to buy an investment property, put 20% down and borrow at 5.5%, fixed for 30 years. Sign me up, again, I know what's going on out there, and that's an incredible deal. And it's really, again, it's incentivizing and it's working together and saying, hey, we're not just going to close up shop and we're not going to let down all of these, clients and investors we have. We're going to have to think about some other ways to get creative, and again, a very big portion of the investment loans that we're doing today are done on these forward commitments. And what I have found in studying, and you probably know this, I study your business. When I was down there just recently, if you walked in my office today, you will see a map of the United States of America that came from your office. I saw that with little thumbtacks of, places where your clients
We've got
are.
That where all of our investors are.
Exactly.
Yes.
So I have the same thing here now. So my point in telling you I study I studied the folks like you that we work with, that how you run your business, all that sort of thing. My point in saying this is what I see today, it's the well capitalized, the turnkey operations that have been at it for a long time and are in it for the long haul. They're not, hey, market's great, we're all in. Market's bad, we're done. It's no, this is something we're doing forever, or for a long period of time. It's what I have found in doing that research is it's those are the folks that are participating in these forward commitments. They're not being greedy. They're saying, hey, how is it a win-win for all of us? And I really think, and that's to go back to the very beginning when I mentioned when I could marry up both my lending practice and working with real estate investors, which is my personal hobby. that's what I like the most about it. It is a group of folks all across the country, whatever the service they provide is. It's everybody kind of coming together as a community, strategizing together, but then doing things like that, saying, hey, we weren't even thinking about this a year ago, 2 years ago, certainly 3 years ago. No, but rates have changed. Here's where we are today. And so we need to help kind of kick in and make things work for the investor, for the client. So,
and it's and just to further prove your point, I mean, this is something that's new. It's new to us. It's new to you guys. We had this conversation in October, and now it's majority of the loans that you're doing. It's majority of the loans or the properties that we're selling are utilizing the forward commitment and this buy down with neighborhood loans. So yeah, I mean, it's a huge part of our day-to-day business, and it just goes to show the partnership and the quickness with which we had to act to kind of counteract the higher rates. But I completely agree with everything you said. They will come down. We all know that they will. We know that it's cyclical, and we'll see a decline eventually. But I was hoping to kind of get that decline at the beginning of the year, though. I gotta be really honest.
And you just wanted to jump on with me here today, so I could give you that good news. And unfortunately, we didn't start off with that good news. But
Lindsay, we'll
I
get
think
there.
of it like this. If I can buy a property today at 5.5%, that is incredible. Because instead of waiting again, maybe till we hit 5.5% in a couple of years, which, let's be real, that may or may not ever happen again. Yeah, hopefully it does.
It may not.
And I think it
may
will.
not.
But if I could buy that property at the price that it is at today, capture all of that appreciation over the next several years, and I have a 30-year fixed rate at 5.5%, I mean, just send me the contract.
Right.
Like that.
Absolutely.
It's such a big difference versus the absence of that. And again, I think it's just showing the commitment you have to your clients. Obviously, we have to our clients. It makes the whole thing work. And I'm a consumer too, and I always try to look at it. And I know you do the same thing because we talk about this. I look at it from, if I'm the consumer, what's going to make it work for me, and then we try to everything from our loan process to a forward commitment to, all that sort of stuff. What's going to make it work for me? Because then that's going to help make it work for that consumer also.
Yeah, I appreciate that, Greg. So our listeners, how do they learn more about you, get in touch with you? What would be their next steps?
Yeah, absolutely. So I'm on social media now. I'm proud to announce it's taken a long time. I have one of the most phenomenal human beings helping me with social media now. So the Iverson group, if you punch that into Facebook, Instagram, what do we do? TikTok, all these other things, you'll be able to find us. The Iverson group, again, at Neighborhood Loans. Or you can just jump on Iverson Mortgage. So iversonmortgage.com. Jump on there. That's got all of my contact information. And I tell you what, I'll give you my cell phone number. I don't always do this, but I'm a human being and I'm accessible, and I don't want to be the person that, I've never talked to him. I talked to all these other people. Like, I'm in the game and I love this stuff. So my cell phone number, it's 636-751-1068. Again, 636-751-1068. Call or text me. I would love to talk through real estate investment, your goals, your wishes. One caveat, and this has taken a long time, my phone goes off at 6 p.m. So if you text or call me in the evening, it's likely you'll hear from me the next day. It's not because I want to be rude, but I have 3 young children that this is why I do this, is I'm clear on that, and so get me during business hours, text me after hours. That's totally fine. You just may not hear from me till the next day. But any questions about this stuff, I would love to talk through it anytime.
Greg, that's amazing. Thank you so much for sharing, especially sharing your cell phone number. That's a bold move. So I appreciate that. But and I love that you shut your phone off too. It's so important to also remember why we do this, why we sell turnkey rental properties, so we can provide this passive income to allow people more time with their families and loved ones, or just doing whatever that they prefer to do. So
Absolutely.
I appreciate you sharing that.
My pleasure.
Greg, thank you so much for joining us today. It was a great episode, a lot of information, a lot of great info. And that's On the House with Spartan Invest.
Thanks.